This is also good for Bitcoin. The Yardstick Metric says 20K Bitcoin is extraordinarily cheap. That's good. But what is the Yardstick Metric? Well, it's the Bitcoin's market cap versus or compared to Bitcoin's hash rate. Okay, which of course is two fundamental metrics. And when you put it all together, this is what it looks like. You can see previous cycles, okay, previous lows. And according to this metric, the Yardstick, Bitcoin has only been at this place a couple of times, right? And what followed after those couple of times? Tremendous pumps, upsides, right? So this is pretty positive. We know that the hash rate continues to go up, making new highs seemingly like every week. But the price has not moved. The market cap has not moved. So there's a big discrepancy between hash rate and market cap. And whenever you have that happen, generally speaking, you have Bitcoin's price being the lagging indicator and it catches up. It always does. So if you look at it that way, it's looking like we have great things coming. Great things coming. So that is awesome. What else is there? Microsoft is getting involved. Well, Microsoft has been pretty pro-crypto overall. Just a little bit. They're dabbling into some crypto projects like this one. Investment in a South Korean gaming firm. We may never heard of them, but still, Microsoft is still good. Also, you have this double bottom pattern that a lot of people are looking at, right? Bitcoin did hit that lower bottom, like the 17, 18,000 quite a bit. So is it ready to break out? Of course, I would argue yes. Yes, and of course, Bitcoin whales are still buying. Addresses with over 10,000 Bitcoins. 10,000. Massively shooting up right now. Not even slowly, massively shooting up. Ton of whales stocking up right now. And it's not just with Bitcoin. I've shown this with Ethereum, with Cardano, with Sheeb, with Doge. I mean, literally all the major projects, you have whales scooping up behind the scenes. Good stuff. Good stuff indeed. Lastly, what's not good is this. Deribit, which is the biggest options exchange for Bitcoin, just had their hot wallet exploited and drained $28 million. So right now, they have halted withdrawals because of it. Now, they say they have most of their funds in a cold wallet, just a little bit in the hot wallet, and somehow it was drained $28 million. So I'm not sure. I'm not sure where to go do if they have enough insurance or they have enough funds in their treasury to kind of pay people back. So right now, this is up in the air. So not good. Hopefully none of you guys have lost money in Deribit. Working. But right now I saw breaking news that Wells Fargo mortgage staff brace for layoffs as U.S. loan volumes collapse. Well, this is one of the consequences of having the fund rate and the prime rate go up so much. You have a 30-year mortgage now charging over 7%, right? When earlier this year it was still at 2.25%, 2.5%, 2.75%, under 3%. So mortgage rates have more than doubled within just 6 months, 7 months time. And it's a trickle effect, right? This is what Powell wants. He wants the mortgage, or the housing market, I should say, to slow down, to soften. But is it going overboard right now? That's the thing. You know, there's a lot of reports like this showing mortgages. No one wants a mortgage. No one wants to pay its current prices now, so prices are dropping, right? So right now, good, but are we going to go too much, right? That's what we don't want. But here's the thing. Here's the main thing I want to show you guys. What has happened previously before and after these rate hike announcements and the FOMC press conference. Okay, so someone laid it out. So that's good. Actually, I'll start with the July. I'll start all the way back. So this is what happened in March. As soon as the rate hike was announced, markets dropped. Okay, dropped pretty hard. And then, boom, went up right afterwards. This is what happened in May. Markets dropped. So maybe whenever the rate hikes comes out, you know, traders, Wall Street, they just get panicky. They don't know what to do. So it's like sell, 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 sell. And then markets rally. Here's another one. Again, in June, big dump after a rate hike. And then a big climb afterwards. And when I say afterwards, it's during the press conference. And I know, I've been doing these FOMC live streams with you guys. And during them, the markets have been doing well. And here's one in July. Just a very little drop. Just like a very, very little drop. And then boom, right? The only thing is the last one, the September one, we also had the same thing. But we had like a double fake out. So we had a pretty big drop. And then we went on a rally, and then we had another drop afterwards. But guess what? What this doesn't show you is the next day following, we had a big climb again. So we had like a double fake out rather than a single fake out in September. But the trend still holds. As soon as the rate hike is announced, you have a big market dump. And then during the press conference, you have a pretty good rally. That's happened every single time this year. So are we going to see the same thing today, where we get a sudden drop with a 75 basis point announcement and then we get a rally during the press conference? I think it's very, very likely. And depending on what Powell says, it could just keep going and going and going and going. We're looking for that pivot language, any kind of pivot language. If he comes out and says, yes, this is what we're doing. We still know that inflation is high, but it's tapering out. So we feel like we could be less aggressive or less hawkish with the future rate hikes or with our future discussions. Like any kind of language that opens up the door of some kind of pivoting will send the market in a frenzy today. So that is what we're waiting for. Right now also, Treasury yields fall as traders await. And this is a good thing. When Treasury yields fall, that means people are more hopeful and less scared. So that is good. So it does seem like a lot of people do think that maybe today could be a pretty good day. But overall, Treasury yields are really screwed up. You look at the 6-month, 12-month. 12 months is actually the highest, almost at 5%. And then you look at a 2-year, 3-year, 5-year. It's not supposed to be like this. This is what's considered an inverted yield curve. You're not supposed to have the 12-year, 2-year, 3-year paying higher interest than 5, 7, or 10. That doesn't make any sense. But that's the reality right now, because there's a lot of people that think that gaining 4.6% for a 12-month Treasury note is better than having money in the markets or just having money in general. You're still getting that 4.6%, but that doesn't offset inflation. You're still losing money overall. And it's much worse in other countries, not just the U.S. So here's an interesting one. This is really interesting. A 10-year Treasury note, this is the returns that you'll get. Minus 15% if you take into account inflation. So you're not really gaining. Just people think that you're losing less or losing slower. So that's the thing of it. But like I said, other countries have it worse. Bank of England is set to have the biggest rate hike in 33 years, 75 basis points this Thursday, following the U.S. We'll see if that happens. Now, this is not a guarantee, though. It could be less, but if it's less, it may actually make the pound go down versus the USD, because inflation in the UK is worse than the US. It's at 10.1%. 10.1%. US is an 8 something percent. And of course, Eurozone is even higher at 10.7%. So of course, Europe is suffering a little bit worse than the US right now. But what will England do in a couple of days? We'll wait. We'll see. We'll see.